What's going on, you guys, and welcome back to the channel. In this video, we have our month-end update. I know it's a little bit late for the stock market challenge. We had a couple newcomers that have breached the top 15. Stick around to the end of the video for that. We are also going to be doing our Q&A. Well, I'll actually put a timestamp up on the video right now if you do want to skip ahead. We had a ton of questions come in here on the Q&A, and I'm actually having a look at these live as we go through. But our first question comes in from Alex Marshall 3 days ago. Why aren't you a big fan of REITs, real estate investment trusts? For example, RioCan is yielding 10%, and looking at the balance sheet, it appears to be safe. As an investor, the stock has 50 to 100% upside once the pandemic passes. The risk to reward is amazing if you're a long-term investor. Really good question, Alex. And let me be very clear here. I don't have anything against REITs. If you followed my channel for a while, I've said a number of times that I don't personally invest in REITs. It's just not an area that interests me, but I have nothing against the REITs. Like you said, RioCan is a phenomenal example. Obviously, they're going to be going through a bit of a struggle right now with a lot of buildings just being less occupied and such. But especially for investors that are dealing with a tax sheltered plan, because FYI, REITs are taxed a little bit differently if you're not familiar with that. If you're holding your REITs in a tax sheltered plan, there is nothing wrong with them. For those of you that don't know, if you aren't following me on Instagram, I'll put a handle up on the screen here somewhere. But on Instagram, we talk a lot more about kind of like my personal life, and it's a little more insight outside of the YouTube channel. But for those that aren't following me over on Instagram, I do own my own home. And I mean, obviously not outright. I have a mortgage outstanding on it. But if you took a look at the equity that I have in my apartment or my condo, there's probably about 130, 140 grand that I have in real estate, in actual real estate, in the house that I own. So to me personally, again, this is all personal preference. When I look at the money that I have in my Quest Trade account, the money that I have in my portfolio, I want to allocate that to stocks. I want to allocate that to companies, to actual businesses to complement my real estate that I already own, right? This is me looking at it from a holistic standpoint. So there's nothing to say that REITs are not good investments. There's nothing to say that you don't get great yields from them or great appreciation, like you said, on a stock like RioCan right now, and probably a number of REITs right now. It's just personal preference for me that it's just, I like to keep my stock portfolio for stocks. Some people like investing in gold, some people don't. Some people like investing in oil, some people don't. For me, I just am not a huge fan of REITs for that exact reason. Nothing against them. Steven Gonzaga asks, who are you? Who are you? I don't even know what that question is supposed to be, but we'll skip over that. In a TFSA from Chengu, if we do swing trading, holding a stock for 4 to 6 months, is there something we can do or is it not allowed? Thank you. I think what you're referring to in the TFSA is that if you're very active, you can actually lose the benefits of it being taxable. And we've gotten this question before. If you're a very active trader, if you're swing trading 4 to 6 months, not even close that you have to worry about that. In fact, they actually, even for day traders, even for active traders, you can get away with it. I saw a post on CRA somewhere. I'll do my best to dig it up, but they don't even have a set number of trades. They don't have a guideline in terms of like a threshold in terms of what defines actively trading in your TFSA to the point where you'd actually get in trouble for it, where you'd lose your taxable benefits. Basically what the CRA will do is they'll take a lot of personal discretion and they'll look into it and they can make that judgment. They can assess whether they feel you're trading too much in a TFSA. But if you're swing trading, holding stocks 4 to 6 months, that is definitely allowed. What factors would you look for when picking stocks or funds that you're going to need in 1 to 2 years? If you're going to be needing the funds in 1 to 2 years, I think it's better to play it safe. It's better to be safe than sorry. I think that's a simple answer there. As much as we'd love to grow our money in the next 1 to 2 years, I think the risk, I mean, assuming you need this money a year from now, you're like, I have a deadline. I need to take this money out for a purchase. I need X amount. I think the risk reward trade-off is just not enough to say I can inch out this much more over the next year, or the markets could drop 30 to 40% and I could have half the money that I need for this. I think if you need the money in 1 to 2 years, it's better to be safe than sorry, but that's just a personal opinion. Bajan Alpha 4 asks, is there really that much of a difference in fees for online brokerages like Quest Trade versus ones from the bank like TD or CIBC. And is there much of a difference? There's obviously a difference. If you actually look into it, you can literally see the dollar amount, Questrade being $4.95, whatever it is, versus like $9.99, whatever these banks are currently at. Those very well may change. Or with Wealthsimple, it's free. There's obviously a difference, but I wouldn't say that it will make or break you. And I've gave this example before. I think a good investor will do well paying a commission. A good investor will do well paying a commission compared to a bad investor who goes commission free. You could have a terrible investor on Wealthsimple Trade and they pay no commissions, they still suck. Or you can have the best investor in the world, and he can pay a $9 commission. He's still going to come out on top. So you pick the right stocks, you buy properly, you buy effectively and timely to, I guess, not pay as many commissions, excessive commissions. You will come out on top. Of course, when you are starting off with a smaller amount, like when you're a new investor with, let's say, $100 or $500, yeah, those commissions do make a difference. But in the long term, I really don't think they'll make much of a difference, assuming you invest properly. Question from David Zito. I bought Enbridge back in May at $44.85. Never made a penny, and it keeps going down, dropping down to $38 as of today. Would you hold on or cut the loss? That, I think, is not the question you should be asking, David. And I don't mean to come off as rough here. I don't mean to come off as like mean at all, because I mean, I'm really just trying to help out and not be mean in any way, shape, or form. But May to now, what is that? That's 3 months, and your stock has gone down. You should not be panicking over an investment over a 3-month period, assuming you're in this for the long haul. If you're in this for the long haul and Enbridge stock is down, whatever percent that is, I don't know how much percent that is off the top of my head, that should be taken as a chance to go in and actually buy more stock. As crazy as that sounds, it really, really is. I know that's so hard to wrap your head around as a new investor, and believe me, I've went through, I mean, when I first started actually working at my dad's firm, I asked the same question. A quick story for anybody watching. He had invested, a client had, at the time, to me, a big chunk of money, $500,000, whatever it was. And my dad put it into a number of stocks, and I checked back in a couple months, and the stocks were down 10%, 15%, a couple of stocks out of the selection. And I remember going up to my dad and saying, did you mess up? Like, did you make a bad pick? Like, is this client going to be mad at you? His stock's down 10%, 15%. And, those are relatively big dollar values when I first started working here. He looked at me and he said, are you kidding me? He said, this is a chance to go in and buy more stock. This is what we want to see. We want the shares to come lower and lower, because then we're getting a better price on it. We're building up our position at a lower price. We all hear the story to buy low and sell high, but it's not an easy thing to do when you see, like you say, in your case, Enbridge dropping down and down and down. But if you can click that mindset, if you can understand that, again, this is assuming we're talking about a good company. If you believe in the long-term outlook of Enbridge, which I'd like to believe so, I think is a good company. I think they're going to do well. Again, this is not advice to you on what to do, but if it were me, I would definitely not be looking to cut my positions. I would either say I'm going to hold it and give it the time it deserves, or go in and actually buy more shares. Keep in mind, you say you haven't made a penny over this period. They still pay a very nice dividend at the moment too. So yeah, your share price, your capital has gone down, but you're still collecting dividends along the way. Just to make clear, you have still made a penny over this time period. That'd be my honest advice for you there, David. Tips or what to keep in mind when buying international stocks, not USA, in your TFSA and RRSP, from TW. Interesting question. This would imply it's a company, let's say an Asian company or a European company for that matter. My tip for that would be actually don't so much go out onto the foreign markets. I'm actually not even sure if Questrade lets you go out and buy, let's say on the DAX, on the London exchange, or whatever the DAX is, the Frankfurt exchange, pardon me there. Or for example, going onto the Hong Kong market, whatever the case is. I wouldn't necessarily do that. You do have a lot of currency risk to factor in. A lot of fluctuations can mess with your investments. And of course, the cost to exchange currency. I'd actually look for something like an ADR or a stock that's traded here. I mean, there still would be a currency conversion there, don't get me wrong. If you're buying a US stock, like take a company like Alibaba. Alibaba is a US Chinese company, but it's also listed here on the New York Stock Exchange or the NASDAQ. Even an ADR like Nestle. You can buy Nestle, for example, which is NSRGY, I believe the stock is. These are companies that are absolutely based out in Switzerland. They're based out in China or Asia or whatever the case is, but you can buy them kind of domestically here. That would be my suggestion for you guys, is to stick with something that's more local. And when I say local, I say the North America is kind of what I'm leaning towards there. But if Questrade allows it and there's a particular company you really want, you definitely could. You just have to factor in currency conversions, which can be a bit of a hassle. Sydney Shee says that the Liberal government just announced a $10 billion plan to invest in infrastructure and clean tech. Will there be some opportunities for investors? Will there be some opportunities? I think absolutely. I think this is definitely a very promising new area. Do I know any off the top of my head? One that we did cover, actually, if you saw the stocks to buy video, New Flyer, the company that makes these buses, these electric vehicle buses. Not sure if it's exactly this plan. I'd have to look a little bit deeper into it, but absolutely, that's a company that, for example, is now getting some government backing. The government's going to be out here pouring money into this space. There will be companies, there will be opportunities for investors. I wish I had any off the top of my head, but unfortunately, maybe go check out the video that I did on New Flyer just a couple days ago or a week ago now. Michael Hidalgo, we'll do a couple more questions here. There was actually so many good questions here, guys, and sorry if I can't get to all of them. I have a TFSA with BMO. However, I'm thinking about closing the account and transferring it to Wealthsimple to invest myself, as I only believe I like a couple companies. Should the money be placed in a personal or a TFSA account? Personally, for me, I would say when you can default to the TFSA, that way your gains, the money you make won't be taxed. A personal account is obviously subject to taxes versus the TFSA being sheltered. Assuming you have the space, assuming you're dealing with a smaller amount of money and you're old enough, of course, Michael, I don't know how old you are here, but I would kind of lean towards the TFSA personally for me. Personal preference, I guess, but I mean, why pay taxes if you don't have to would be the clear, obvious answer. And the last question that I saw here that I really liked, Fernando Orozco. How do you know when a company you're wanting to invest in has a toxic or suspicious work culture? For example, companies like you, Theranos and Nikola were pretty obvious for me, but I don't know how to realize when a business is going the wrong direction with their leadership. Any advice? And that is such a good question. Honestly, it can be very tricky, first of all, to catch when things go downhill, like a company like Nikola with fraudulent types of things, or Luckin Coffee, I think is one, where there's a bunch of fraud within the insiders. It's really tough to say until something actually happens. But that's why when we talk about, when you look at anybody, well, not anybody, but you look at, for example, Warren Buffett's, if you look at his checklist for looking into a good company, one of the major things is management. That is one of the first things that he'll look at. That has to be a strong component of this business. And when you're looking at new companies, like companies that are just being brought up, or IPOs for that matter, you simply don't have that history. Like, you simply can't look back at the history of these new CEOs or the executives because there just isn't any. You can obviously try to look deeper into a person's history or their past. Go Wikipedia or look into the previous roles that a CEO or executive played to see if they have a history of doing good things, shady things. Have they been in trouble with the SEC or fraud or anything of that sorts? But that's why I think it's a clear reason why you should stay away from these smaller up-and-coming companies. When you look at some of the biggest CEOs in the world managing the big blue chip companies, you can literally look back at all their past roles. You can see how they've developed. You can see how they've been nurtured. That to me is, that's why these smaller companies come with risk, because you don't know these types of things, and it's very tough to tell until it happens. I actually came across a website, I believe it's called Glassdoor or Glass Window. I'll find it and I will post it up on the screen for you guys. But it's actually a company, it's called Glassdoor here, and don't ask me how I came across this, but I did. You can actually search up publicly traded companies and look at employee reviews. So reviews on the CEO. You can actually see here they have a list of top CEOs in 2019. AMD CEO with a 99% approval rating. The KEG, Ubisoft, IKEA. You see here RBC and Cisco and Satya Nadella. These are all employee ranked, or it's employees that I believe are doing the reviews here and actually giving their opinions on the CEOs and executives. That may be a good way to look for good management, but again, you're not gonna see like a terrible manager here. You just gotta kind of look for the red flags, I guess. That'd be kind of my answer to that question, at least on the top of my head now. But that'll wrap up our segment here for the Q&A section. Let's dive right ahead on into our stock challenge update. And what you're looking at on the screen here was last month's update with Joshua, Nareem, and Ken always up at the top, Brian up there chipping away. What you now see with the color representation is up to date. These are as of October 8th. This is Thursday numbers. We see Joshua still up top with about $653,000. Brian has inched up. Nareem, Ken dropped down. We actually see, if you scroll down to the bottom, we have some newcomers like Brock, Gabriel. I actually saw Brock had some pretty nice performance out of Neo stock, which is up, I saw about 400% year to date. But that right there is our up-to-date look at our stock market challenge. We have about a quarter left to go, and I think this is anybody's game. Honestly, I think that anybody here could get swung within a number of months. Let's go through the list very quickly to see how everybody's doing on the ranking. Here it is. Again, feel free to pause as always to see how you're doing. Leave a comment down below to see what position you're in. But that right there, guys, is our update. And we'll give it a second here to finish off. Let's take a look here. Like I said, we got 3 months left to go. All of October, all of November, all of December, which could be a wild, wild end to our already wild year with elections coming up. And as I'm seeing on the news, there's cases spiking up. I think I saw Paris was looking to lock down again. I don't know what to expect here, but what I do know is that we have a nice race up at the top of the leaderboard. And I think on the next update, we will do a breakdown of what the top 3 or top 5 portfolios are looking like. So coming down the home stretch, we can really start to monitor which stocks will be driving either of these people to a victory. This is, of course, our series or our year-long tournament or challenge where there's $1,000 on the line. If you are new, you don't know what we're looking at here. All of these people submitted, it's a free challenge just for fun, but they submitted a list of 5 companies. We took a hypothetical amount of $100,000 and divided that between the 5 different companies. And you take a look, for example, at Joshua, who's today up at $653,000. So 6x his money, despite one hell of a year that we've been through. Pretty impressive with the stock picks. And in the next update, we'll go through and take an in-depth look at it. But that is all for today's video. I hope you guys enjoy. If you did enjoy any part of this video, feel free to give it a thumbs up. Subscribe for more content if you are by chance new. But that's it for the video, guys. As always, we have our Investing Academy down below. If you want courses and training on how to learn this whole stock market thing, first link in the description there, or you can visit our website. But as always, I thank you guys for watching. I hope you enjoyed, and I'll see you in the next video.